Welcome everyone in Bankland. Thanks for watching. We've got another great event that covers what we think is a unique phenomenon in community banking, how community and regional banks are turning to investment banks for their talent needs. Quick introduction, I'm Brian Love, Head of Depository Recruiting at the Travillian Group. Travillian is a boutique executive recruitment firm serving the financial services space since 1998. And over the past 20 plus years, we've amassed an incredibly deep network comprised of bank executives and industry professionals, as well as many of the key advisors and consultants in the space. My division specifically covers community banks around the country, and our primary focus is to assist our bank clients with talent acquisition and executive and board succession planning. With the recent founding of FICOR Staffing, we are now well equipped to assist banks on their recruitment needs from C-suite down to the mid-level and junior players who possess pivotal skill sets. Please connect with us on LinkedIn, Twitter, or YouTube and visit www.travilliangroup.com to learn more about how Travillian can assist your institution. So today we're very excited to bring together three panelists who grew up on Wall Street, but are now situated in strategic executive roles within community and regional banks. Without further ado, I'd love to introduce today's panel. First, we have Collyn Gilbert, who recently joined Valley Bank as Director of Strategy in December 2020. Prior to joining Valley, which is a $40 billion in assets based bank in New Jersey, Collyn was with KBW, where she served as a Managing Director in Equity Research since 2013. And before this, she served in a similar capacity via Stifel's acquisition of Ryan Beck and Company in 2002. Live from a very chilly New Jersey, welcome, Collyn.
Brian.
Glad to have you. Next, we have Jefferson Harralson, who serves as the Executive Vice President and Chief Financial Officer of United Community Banks, a $17 billion in assets holding company based in Georgia. Jefferson joined United in 2017, also from KBW, where he was a Managing Director and Associate Director of Research from 2002 to 2017. From not so chilly South Carolina, welcome, Jefferson.
Thanks for having me, guys.
Pleasure to have you, Jefferson. And rounding out our panel, we have Jeff Jones, Executive Vice President and Chief Financial Officer of First Busey Corporation. Jeff joined Busey in 2019 and has more than 20 years of experience in investment banking and financial services, most recently serving as Managing Director and Head of U.S. Depository Investment Banking for Stephens. From Illinois, welcome, Jeff.
Great to be with you all today.
Well, great to have you as well. And also, I have the distinct pleasure of presenting my co-moderator, Joe Fenech. Joe, I'll throw it to you to get started.
Thanks a lot, Brian. Good to see everybody. I'm Joe Fenech, Chief Investment Officer of GenOp Capital Management and content contributor for the Travillian Group. So this is the third webinar that Brian and I have moderated together. I think this one is unique, just in the sense that it's likely to be relevant to hopefully all of our listeners, all the constituents of the bank sector, you know, from boards and executive management teams to at banks to, on the other side, people on Wall Street, buy-side investors, sell-side analysts, investment bankers, and others. So we want to better understand this trend, why it's happening, what's driving it, what the transition was like for the three panelists, and how it's worked out for them so far to date. So guys, thanks for joining us today. Why don't we just go ahead and dive right in here. So Jefferson, you made the move of the three panelists we had today first. So first question to you. You know, certainly there were people that made this move before you did, but I sort of think of you as a trailblazer here, really in the sense that the trend really started to pick up momentum after your decision almost 4 years ago now to leave your role. You're one of the street's leading bank analysts, my opinion, at KBW for the CFO position at UCBI. Can you talk to us about your thought process? You know, was this career pivot something that you had been considering, or was it purely opportunistic and you hadn't really thought about it when the UCBI opportunity came up? And then what were some of the specific considerations that ultimately led you to make the jump?
All right, thanks. Thanks for having me on, guys. And Collyn, great to see. It's great to see you again. Great question. It's a great panel to be a part of. I would say it's a combination of things, but opportunistic. I would say more opportunistic, but at the same time, I felt like the process was thrust on me a little bit. That was I felt like I had 10 years left to work. The sell side economics was getting a little bit weaker. I had been paid down 2 years in a row, which is never a fun thing. And our DOR spot, which I was aspiring to, had a great person, Fred Cannon, sitting in it, and he was going to stick around for 4 or 5 more years. And so I started thinking about other things. I love my job as an analyst. I love my company, KBW, but it was sort of a need to think about what my career was going to be for the next 10 years. I had seen that UCBI was a company I knew very well, and we can talk about it more a little bit later, but I saw they had for their CFO, and I sort of put my name in the hat for this search, and I ended up somehow getting it. But that's a little bit of the background. It was a little bit of I felt like the United had a really nice 10-year runway, and I felt like the sell side did not, for me at least.
I'm sure all of us former sell-siders, maybe current sell-siders, identify with your comments there. Jeff, your situation was a little bit different from Jefferson and Collyn as research analysts in that you were a very successful investment banker. Prior to joining First Busey as CFO a couple years ago, as Brian had mentioned, you were the head of depository investment banking at Stephens. What was the impetus specifically for you personally to make this move?
Yeah, and again, great to be with you, and good to see you again, Joe, as well. I had enjoyed a great career in investment banking, kind of 20 plus years calling on depository institutions. And, the reality is the last 5 years of that was probably the most gratifying and fulfilling of my time in investment banking, working with just an outstanding team of professionals at a great firm in Stephens as we built that practice. So truth be told, I wasn't looking to make a move, right? But how does the old saying go? Sometimes what you're looking for comes when you're not looking at all. There was a lot that spoke to me about the opportunity when it was presented itself with First Busey. Obviously a great company, the compelling business model at a critical juncture in its evolution. The company had grown over 2x in less than 4 years, both through organic and a series of acquisitions, had been working hard to diversify its business footings geographically, with still a lot of runway ahead of it in that regard, and was sitting on the precipice of $10 billion following that growth. That is obviously a clear, critical, strategic juncture in the company's history. And coupled with the fact that a lot of very interesting and unique opportunities, even away from the bank, in the company's wealth management and payment technology subsidiaries. So, it was, all of that spoke to me, and it was, in my estimation, a company that I knew very well. They had been a close client for a number of years, led by an executive management team that I had a tremendous amount of respect for, as well as, established chemistry, rapport, and trust with. And all of that was very critical here. Fact of the matter is the collective experience of 2 decades in investment banking is what put me in position to have a great opportunity like the CFO role with First Busey present itself. And, great opportunities don't come along every day.
Great. I appreciate that perspective, Jeff, and we'll dig into that, your decision process a little more as we work through here. Collyn, your decision was much more recent. You joined Valley as Director of Strategy from Stifel KBW just this past December, so going on 2 months now. Like Jefferson, after a long career as a top bank analyst, why was now the right time for you to link up with a regional bank like Valley?
Well, I also will thank you, Joe and Brian, for inviting me to attend today. This is great. It's great to see Jefferson and Jeff, so thanks for that. So, not dissimilar to what Jefferson and Jeff have said, but I think the difference for my experience is we had this pandemic strike us last year. And I think a lot of it for me personally was perhaps the 6 months of isolation, or just kind of thinking about life and taking a risk very differently, given that the world had just sort of been turned upside down. And I think, as Jefferson has said, and Jeff said, it points almost everybody at points in your career, kind of thinking about maybe making a change or the next career path. But I think for me, it was just the pandemic honestly opened my eyes and kind of pushed me to a place that I wanted to make a change and was ready to try something new and ready to take a new risk. And I think on a personal level, it's hard to leave equity research, right? The benefits of equity research in terms of flexibility of life and balance. But my kids now are in high school. I have a husband that's semi-retired. So just on a personal level, my situation was such that it kind of opened up the opportunity for me to take on something new. So I'll say it was definitely pandemic driven for me to make the move now.
Interesting. Reasons, and my story kind of echoes yours, Jefferson's, a little bit. It's interesting though. I think that for the three of us, it sounds like we were really reluctant to fully let go of research. Like we love the job so much. Sounds like from you guys are on the same page as me on that. It's part of the reason why I'm working with Travillian now, is I can't quite let go of some of the aspects of the research role. So interesting to hear that you guys seem to feel a bit of the same way. But Brian, I'll just turn it over to you.
Yeah, well, Collyn, it's interesting. I've got another question for you, but how the pandemic kind of shaped, your career. Out of the three panelists, you're the one who made a jump during the pandemic. So that makes you the craziest, I guess. No, I'm joking. But I have a question here. So certainly every situation is different amongst the three of you for sure. But given the prevalence recently of this move from Wall Street to Main Street that we're investigating today, it stands to reason that there would be some commonalities. So from your Wall Street perspective, what do you think some of those common factors might be that are leading so many people to choose this route?
Yeah, so, I think despite having made the decision kind of quickly during the pandemic, obviously, and Jefferson touched on this, we're working in an industry on the Wall Street where it's been struggling. The industry's been struggling. It's not been a growth industry. As Jefferson pointed out, 2 consecutive years of pay down, that could spur you to think about things a little bit differently. The introduction of MiFID. And I think for me too, a kind of an impetus to start thinking was just when, you realize the metric that there are more ETFs than there are stocks, and what the impact that was going to have on fundamental equity research, and sort of knew that was changing. So I think, seeing a lot of headwinds facing the industry on Wall Street and certainly within equity research, I think that's one side of it for people kind of rethinking. And then the draw to Main Street, it's funny, after having been a bank analyst for 25 years that I'm saying this, but, I guess the perception has always been that banking is kind of slow moving, more reactionary, not necessarily full of visionaries. But I think what we're seeing now and what we've seen is that this is an industry that now does need to adapt and is in need of change agents. And I think, you've got a perfect example of us, all of us on this webinar that are kind of embracing that. So, I think the desire for me to go to Main Street was seeing that opportunity for change and the need for change and the need for kind of a diversified way of thinking, which just wasn't necessarily, Wall Street is a much more mature industry than I think what we're seeing in kind of commercial banking. So that for me was the draw to kind of go to quote unquote Main Street Bank, is that it seems like it's really in an inflection point now of how the industry is thinking about change and how that's going to be implemented.
Well, and Valley is definitely a very progressive organization, so it's going to be a lot of fun for you, as are the other 2 organizations as well. Jefferson, I'll go to you next. So the other side of this equation, in my search work here at Travillian, we know a thing or two about what makes a good stereotypical CFO. What specific skill sets and talent do Wall Street people bring to the table that these banks are seeking out and wanting to bring into their organization? And, is it a fresh perspective? Is it analytics, dealing with investors, merger advice, all the above? And why are banks prioritizing these skills more so now than in the past?
Yeah, I'll say a couple of things along those lines. I wanted to circle back on something that Jeff said too. With United Community, as an analyst, I cover United Community. And he is an investment banker there, and as Collyn is somebody who covered it. It does give you some unique insights into some things you see that are changing that I wanted to be a part of. So I was very excited to be part of what is a growing, changing story at United. Now, within that, what did they see in me? Is a good question too. So I think the strategic piece was a big piece of it. I think over 20 years of being a sell side analyst, seeing hundreds of bank stories, hundreds of banks do the right thing and make mistakes and change. So I think the strategic piece of M&A, the strategic piece of capital markets, the strategic piece of everything, I think is something that the banks are looking for. You can have your accounting team in place and have someone like Jeff or I in the seat and be a little more strategic in how we think about things. I also think Jeff also mentioned the rapport and the trust that you get from a long-term relationship of being an investment banker or an analyst with a company. And what I've learned being at a bank is that everything is a team project, and that everything you have to have complete trust in the rest of the people on your team. If Lynn Harton, my CEO, were to go into a coma and come out 6 months from now, I think he'd want to know that his CFO is taking the right risk and avoiding the right risks that he would expect that I would do during his coma. So a lot of it is rapport, it's trust, it's the strategic piece, I think, to our typical skill sets that some long-term treasury accounting people don't have in the industry.
That's a great response. Rapport, trust. I mean, those are key fundamentals for any bank executive. So Jeff, I wanted to ask you something that's kind of near and dear to me as well. We all know that there's kind of a succession issue that kind of plagues the banking industry. It's been a major driver of consolidation for years and will likely continue to be. The training programs that existed years ago are gone. And I think we can all agree that the sector hasn't been a hotbed for younger talent due to financial collapse and whatnot. So is that one of the reasons why banks are looking to Wall Street to talent, you think? And looking out longer term, can Wall Street help to fill that void, or will having Wall Street people in senior roles with their history as deal makers actually help to further the pace of consolidation as this Wall Street to Main Street trend becomes more prevalent?
Well, I appreciate the question, Brian. And, there's a lot to unpack inside of it. I do think there's a fair amount of truth to your comment, although, I would say, my personal belief is the issues of finding talent that rise to the point of creating succession issues that ultimately drive a company to sell or partner up with someone else are occur disproportionately at the smaller end of the market, particularly where community banks are private, closely held companies, smaller in size, and struggle to attract, develop, pay for and retain talent to manage, grow, and drive necessary change. Collyn made the comment about change agents, right? There's a cost, to acquiring that type of talent, and let alone find the talent you need to continue to drive that change through multiple generations while delivering shareholder returns. So the reality is those smaller institutions are unlikely to solve their challenge by looking to Wall Street. But on the flip side, talent acquisition and development is a critical issue for all of us, for the industry as a whole. It absolutely is. And, the onus is on each of us, to create a culture and a strategy and business plan and an innovation mindset that'll cause talent to gravitate to the platform. And for the companies that do that well, that talent's going to be comprised of a portion that's homegrown and a portion that's come in from the outside. That mix of internally developed talent injected with kind of the fresh, unique perspective of new ideas, skill sets, experiences from other arenas, other companies, other industries, that's externally sourced is critical to the development of a progressive, learning organization, if you will, that can evolve its strategy in a way to keep pace with change and innovation in the industry. And I think that's where the opportunity will continue to lie for attracting talent from Wall Street into the space. But the same could be said for attracting talent from other financial institutions or fintechs or Silicon Valley. But yes, I do believe the migration from Wall Street to Main Street, as you phrase it, for banks will continue. And the fact of the matter is, and both Jefferson and Collyn alluded to this as well, the continued consolidation of Wall Street is going to create those opportunities that banks can capitalize on in the search for talent. As it relates to the question of whether having folks with Wall Street experience in senior management roles will accelerate or could accelerate the pace of consolidation, perhaps, but I really come more from the school of thought that the ultimate pace of consolidation is going to be dictated by market and economic forces. And where the actors have the greatest influence, is on the nature, types, and terms of the deals that get put together. And that's where I think an increasing presence of Wall Street experience inside banks will have the most influence in shaping timely, relevant, forward-looking strategy. Again, that change agent bent, and then putting together the puzzle pieces that align that strategy for any given company, while maintaining discipline on the financial merits, and then ultimately, sourcing the financing necessary to capitalize the consolidation.
Well, terrific, Jeff. That's, great response. And, just going back to what you just mentioned, how the smaller banks aren't going to solve their problems through Wall Street. That's a great point to make. We actually put some questions out, or we asked our network for questions, I should say. And the first question that came back is from a gentleman named Mike Rantilli. He's the CFO of Middlefield Bank in Ohio. I want to just open this up to everyone, whoever feels comfortable in responding. Mike asked, he wanted us to gauge if this particular trend may eventually have impact on CEO roles at community banks. He mentioned that he's seen more top spots being filled by those with financial and strategic backgrounds rather than more traditional lending backgrounds. Do any of you agree with that assessment? And if so, why do you think that's occurring?
Take a stab at that. And interesting from my perspective, and while I've only been at Valley now for a short 2.5 months, it's interesting. I would say that Ira Robbins, the CEO of Valley, and his leadership team kind of run Valley more like a business than a bank. And that might seem like a subtle difference, but I don't think it's a subtlety that should go unnoticed. And I think that type of structure or mindset kind of requires more strategic skill sets. And I think if you think about the industry and where financial services is going and what you're going to need to do today as an organization to get there, does require, I think a much more of a strategic mindset. Lending, of course, is certainly very important. It's the foundation of so much of what the banks do. But if we think about what the industry is going to look like, 5 years from now, 10 years from now, and the change in the way that payments is being utilized in digital and all of that, I think it just requires somebody to think a little bit more outside the box and a little bit more strategic. So I think we could see more of that certainly coming into the fold, at least in the near term.
That's a great response, Collyn. And I think Jefferson mentioned just the power of relationships. Lenders have relationships; they're front of the house. That's their bailiwick. Investment bankers have, tremendous relationships with a completely different set of folks. So that's that's an important piece there, and that's what makes a good leader. I don't know if anyone else wanted to take a stab at that response, or we can move on, and I can pass it to Joe.
I'll throw in just one quick thing. I think the door is open for Wall Street leaders to come in and be leaders of financial institutions. I think that a great leader can be a great leader in both places. I do think that having a lending background is so key to what a bank is that I think it's going to gravitate towards the lending side of it. But especially as companies get bigger and they get more complex, like Collyn was talking about, and there's more technology pieces in it. But the central piece of this is leadership and great leadership and the ability for a person to be able to lead eclectic pieces of what's becoming more and more complex. So it doesn't exactly matter where you come from, but you have to be a pretty special leader to be able to manage and drive a relatively large organization. And they can come from anywhere, Wall Street or the bank.
Good point, Jefferson. I feel like the great CEOs that I've had the fortune of being able to interact with, they really could have been great CEOs in a wide range of businesses, right? So I think you're exactly right. So we've talked a little bit so far about what's driving this trend and why you all made your decisions. Let's talk a little bit about the actual transition process, the nuts and bolts. So Jefferson, I remember thinking, you made your announcement a few years ago when it was made public, and it wasn't just me. There was a lot of chatter amongst people that were like me, still in their seats. And I thought, wow, that's a bold move. On the one hand, I knew a lot of, we all knew a lot of CFOs in the business as analysts, and I had a general sense of what their responsibilities were. But on the other hand, I felt like if I had to step into the role, I wouldn't know what the heck I was doing on day one. And I think that others might feel similarly, and maybe that stops some people from maybe pursuing a role that once they got acclimated to it, they'd actually be really good at. This kind of corresponds to a question from our audience, Andy Borman, who I know you know well. He made a Wall Street to Main Street move a few years ago. He's now the CFO of Southcrest Financial Group in Atlanta. He said he quickly realized that there were several duties that were unfamiliar to him when he made his move. His question is a good one and ties into my comment here. So what are the specific job tasks that you didn't realize you'd be responsible for, and how did you handle that? How did you get your arms around it?
Well, I had Andy's a great guy. Hello, Andy, if you're on right now. Thank you for your help in my transition. Well, I'll say a couple of things to that. One is I had a really nice thing in that UCB eased me into my transition by keeping the former CFO on for 6 months, Rex Schutte. So I was able to have some overlap there, which really helped me on the things that I didn't know. I was able to ease into it, which was a great thing. My biggest apprehension coming on the things I knew I didn't know about was dealing with regulators. I had never really had a lot of interaction with regulators. Then when my first meetings, I wasn't exactly knowing where they were coming from. That was a new thing for me. And outside auditors is somebody were people I had never dealt with before. And so those are two very important constituencies. I was worried about of how to form that relationship. But what I learned more on the specific pieces of a bank is that there's just so many very, very specific things that a CFO is never going to know about. So there's a lot of pieces that I'm still not going to know how to do exactly, but we have specialists in place to do that exact task. And so whether it be collateral on a securities book, whether it be pledging, whether it be liquidity, whether it be the wire room or the accounts payable, all these things, I could be lost if I went down and sat in the seat. But my plan is to get them what they need to do their job well, and then get out of the way and let them do it.
And Jeff, similar question to you, coming from a different background than Jefferson. Did you have any initial hesitation? And if so, how long did it take before you felt like you weren't drinking from the fire hose in your new role, considering that you were, like I said, coming from a different side of the business than Jefferson, from what you had been doing for the past 20 plus years or so? Was it overwhelming, and how long before you really felt comfortable in the role? And I'd add to that, of course, that the pandemic was thrust upon you within a few months of you joining. So I'm sure interested to hear your perspective on all that.
Right, and immediately preceding that, simultaneous merger integration of the largest acquisition in the company's history and a core system conversion on the entire bank. Yeah, that's how I started. Look, I wouldn't characterize it as overwhelming, and I never felt coming into it or since being here that it was overwhelming. But I would certainly say the transition is daunting and demanding. I had a number of peers, former clients, confidants tell me when I took the job look, expect it to take 12 to 18 months, or in their parlance, 4 to 6 quarters, to get your legs under you and find your groove. And I think in retrospect, in a somewhat normal operating environment, that's a really good expectation. And it's probably closer to the outside of that range. The reality is you need to go through everything a couple of times. Jefferson alluded to some of these things, but, reporting cycles, budget cycles, audit, annual audits, year-end processes, proxy seasons, performance reviews and compensation, cycles, regulatory exam cycles, audit calendars. When you come from the outside or the other side of the table, as the case may be, these are totally different processes on the inside than how you were exposed to them on the outside. That's just the reality. And then there'll be things that you couldn't plan for, didn't foresee or anticipate. So while you have to be focused on progress and have a roadmap in mind to guide you, you also got to be agile and flexible and just at peace with the fact that you're not going to control every aspect of that transition. In my case, as you alluded to, Joe, I came in with this great first 100-day plan in mind, and that went in the desk drawer about, certainly within 10 days of me taking the job when I realized what it was going to mean for the company I just joined to go through a total company core conversion and simultaneous merger conversion, 5 weeks after I arrived on the scene. And so then just when ready to bring the 100-day plan back out of the drawer, I literally circled on the calendar, get through first quarter earnings, the conversion's behind you, get it out, get it to the street. February 1, the 100-day plan's coming back out of the drawer. And, within 2 weeks, we're in daily crisis management meetings for, the onset of a global pandemic. So I think what I would say is, the key is to orient yourself to thrive off the challenge of the transition and just to keep driving forward, making progress kind of every week, every month, every quarter.
Is there ever a time, guys, when speaking in the CFO role, where you feel like you can carve some time out to kind of, whether it's a strategic project that you kind of had in mind, or how long before stuff just stops coming at you? You talked about cycles of reporting and all kind of does it ever stop, or you have to is that just basically off hours when you pursue projects that you have a special interest in, or go ahead.
Well, your on hours are nowhere near what the the old prototypical thought of banking was. This is not an 8 to 5 job. So your point's a good one. I mean the one thing I would say that I even underestimated, and I had a lot of people prepping me for it, is how much of my calendar for the week, is spoken for, by Sunday night, right? And it's a lot. It's a lot. And so, to Jefferson's earlier points, you got to have, key lieutenants, right? You got to have folks that, are highly leverageable, that help fill in the pieces where you have gaps and where you can't get, you got to be willing to get in the weeds, but you can't get lost in the weeds, right? Because you do need the time, to focus higher level on strategy, on helping to run the company, on bigger decisions, forward looking, opportunities. And, you got to make a point to carve that out. And I would tell you at times, I block time on my calendar for just that, because if it's not blocked, someone else may take it.
Got it. Interesting.
There's definitely a seasonal element, KQ, proxy, call report, earnings, sorts of things. But also there's an element I found too that's similar to being an analyst, which is some things come and go, right? So we had our plan for 2020, and all of a sudden it was a margin, a year to think about the margin. And all of a sudden it was a year to think about the investment portfolio. We weren't thinking about it. All of a sudden it's a year to think about expenses or other things. So it's definitely some themes come and go that you weren't expecting to happen. But at the same time, you have almost like your day job which is making sure that the wheels turn on the things that happen all the time.
Collyn, your situation a bit different from these guys, where you have a role that's new to Valley in terms of director of strategy. So on the one hand, you'll presumably have input into kind of how that role evolves, and it can go in many different directions, right? On the other hand, I'm sure it's challenging in the sense that, unlike a CFO role, like these guys are talking about, that it's pretty well defined. You're not only switching gears in terms of your career path, but also in a role that's completely new for you and the company. So what can you tell us about your position and how you settled on what that role would entail, and how do you think it evolves over time?
Well, you guys said it earlier in the webinar that I was crazy for making a change in the pandemic. So let's, yeah, Brian said that. So let's start there. And listening to Jefferson and Jeff right now, I'm thinking, wow, that's really good advice. Like I gotta take notes. I gotta take notes. And I laugh because I did, of course, reach out to Jefferson when this came about. And this still sticks with me, Jefferson, and I haven't had a chance to chat with you about it. But one of the things Jefferson said was, don't go to a meeting if there's more than 4 people at a meeting. That, coupled with Jeff saying that his schedule for the week is set on Sundays, like that has been the most craziest transition of this whole thing, is meetings after meetings. And anyway, I digress, but I just had to get that in. Your comments just struck me so poignantly. But Joe, you're totally right? It's a completely clean slate for what this role ultimately probably will be. And I think coming into it, I think the intention was for me to help kind of streamline a lot of the strategic priorities within the bank. If you guys have met Ira, you see he's got a ton of energy. He's got so many ideas. And it's funny, I had lunch with him at the beginning of this process, and he's running through all these things that he's thinking about. And I'm like, Ira, how are you doing all this? And he's like, well, this is why I'm going to hire you. So there's a lot of, I think, organization and prioritization of strategy and initiatives was the initial thought. Now, after having been here for 2.5 months, not surprisingly, the role is a little bit different than what I had anticipated. And part of that is, I think, on me, and that I've just really spent so much time digging into kind of the bones of the bank, exactly understanding exactly how we work and what we're good at and where we maybe need to evolve. And I think that's probably coming from the fact that and I think, Jeff, you said it, or we've all experienced it, right? When we're on the outside, it's something to assess from the outside, but then when you get in the inside, there's just so much more to learn and dig into. So for me, I feel like before being able to really contribute in the way of setting a strategy or advising in that way, I have to really understand, well, how are we positioned today? What are we good at? What are our tools? What are our capabilities? So I think, over time, it will migrate more towards some of the strategic components. But I think for now, it's really, we're moving at a very, very fast pace here within Valley. I'm sure every organization is. So I think, helping sort of dissipate some of that speed and allocating it in the right direction is kind of where my role has been to date. But it's a lot.
Well, I don't want to go too far off script here, but I just wanted to throw something at you because you're not stereotypical CFOs or directors of strategy. How does hiring folks like yourselves affect a bank's recruitment strategy? Because, again, you may not be the most stereotypical CFO, Jefferson and Jeff. And so maybe there's things that you bring that are not at the bank that you need talent-wise. I don't know if you mind me throwing that at you.
So yeah, I'll start with that. So I think if you're coming in as unprototypical, the head of accounting is a very key role. We have had a 20+ year head of accounting here. His name is Alan Kumar. He's amazing at what he does. So that role needs to be in a really good spot. And then I need to bring him everything he needs to be happy and healthy in his job. The treasurer role for a CFO, the treasurer role is very important, especially in 2020 when you have liquidity that's coming out everybody's ears. You have a very fast growing securities portfolio. So I think there's I think really with every CFO, those are really important pieces to have in place. Now we can take over some of the M&A and some of the IR and some of the strategic pieces of it. That comes really natural to us. and then really, work with your key teammates to make sure the pieces that I'm not going to know as well are in place. So possibly if you're coming in unprototypical, you might need, more senior, experienced people in those spots.
Interesting. We're doing another webinar. It's called Help, My CFO is an Investment Banker. It's with all your heads of accountings and treasurers. No, I'm joking. Anyhow, thank you for that, Jefferson. We went off script. Nice ad lib there. And next topic is, kind of starting the career pivot process. There's not a week that goes by I don't talk to a candidate that may be coming from a similar, place that you came from. I think they'd like to hear some of this. And the first question is for Jeff. You mentioned some of this in an earlier answer, but I want to delve in a little bit deeper. All three of you actually joined companies that were in the region where you focused your career on Wall Street. And Jeff, you mentioned how the personal relationship that you had with the company and the executive team was important. I'm asking this because most people making this transition seem to already have some sort of prior relationship with the executive team. In your view, is the personal relationship crucial, or should the Wall Street person or a bank looking for talent cast a wider net beyond just their personal relationships?
Yeah, and I would just say, and there's, embedded in your questions, two different perspectives, and I'll maybe touch on both briefly. But for me personally, from my perspective, it was hugely important. And you referenced it. I alluded to it in my earlier remarks. I don't believe I would have made the move I did if not for that strong relationship and history and appreciation for Busey's executive leadership team and its board. The folks that would become my partners, as well as intimate familiarity with its business and strategy, and really the opportunity set in front of it. And all of that was developed over many years with the company as a close client of mine. As I mentioned, I was in a great situation with great partners. So there was no way I was leaving that without a tremendous amount of not just confidence in, but comfort and compatibility with the company and the leadership team I'd be moving to. But that's from my personal perspective. And the second part of your questions really gets to the perspective of the other side of the trade, which is the company making the hiring decision, right? And at the end of the day, my view is the personal relationship is additive and certainly a plus, but the skill set is the uncompromised prerequisite, right? Without the skill set, you're not in the room talking about the opportunity. And so no one's going to offer you a critical management position just because you're a good human being or have a positive relationship history or, that you have been a trusted confidant on key strategic matters. You still have to have the experience and skills demanded by the position to be in that room. In my case, that meant I was inserted into a national search process that lasted for about 5 months. But I do believe that history of a strong working relationship, trust, and mutual respect was a valuable differentiator at the end of the day.
Terrific.
I just might add in on that because it's so similar. I was also in a national search, was also 5 or 6 months on there. So besides that, I would just agree with what Jeff had to say. I like to say I did the longest due diligence ever. Covering the bank for 15 years before joining it.
Well, Jefferson, the next question is for you. One thing that can be challenging for a research analyst seeking a career change are the rules that are in place to help avoid conflicts of interest. There are restrictions in terms of publishing research and simultaneously going through any interview process with a company. Then you have the matter of the firm you work for, where once you inform them that you're going through a process, the cat's out of the bag. So it's a difficult situation, more so than in other areas, because the rules aren't as strict. What's your advice for an analyst that is looking to make a change, but just isn't sure how to take that step?
Well, there's definitely, I didn't really see anything in the handbook about interviewing for companies that you cover. So, And I was actually hoping I would never be asked this particular question. So thank you for asking
The
this.
world is listening.
And as Collyn will know well, we have there's always some names in your coverage list that people are paying more attention to, and you're doing day-to-day sorts of things on. And there's others that you kind of have a market perform on at the time, and you're just sort of going through the right up the quarter and move on. So as I started interviewing with United, I kind of moved it to phase 2, which is right up the quarter, and move on, and just kind of cross my fingers that nothing controversial would happen during that time frame. And I didn't really think anything controversial was happening or any kind of big news. But ironically, the day they offered me the position and I took it, they said, because we have a deal we're about to announce tomorrow. So you're now going to be presenting about this particular deal. But to step back a second, just and kind of go back into if you're an analyst or investment banker and you want to be on the other side. I mean, Jeff said it so well. I mean, the skill set is management, it's leadership, and then the relationship piece helps because there's so much trust that has to happen when everything is a team, everything's a team game. So I would. That's one thing that, as an analyst, you have less of, or as an investment banker, most times you have less of, is the leadership and management experience. So that's a piece that to work on and build up, because that's what this role requires the most of, that you don't get naturally in the on the investment bank side, in most cases.
All right. Well, thanks for that response, Jefferson. And yeah, sorry to put you on the spot there, but a great answer. So Collyn, I have a question for you. If you were presenting to a finance class of college juniors and seniors, for someone that hadn't yet found their passion and was looking for advice, what would you advise in terms of career path? Go to Wall Street, go to Main Street, go to grad school, or none of the above?
So it's interesting. I actually spend a fair bit of time with finance students. So I'm in this situation quite often. And I think for a while, and consistent, and I would still do it, is I've pitched equity research as a great place to start, I think, for college grads. That said, I'm also mindful of recommending students going into an industry that's in the midst of such significant change the way Wall Street is. As we've alluded to, the pay scale has changed. You know, the innovation, the industry is changing quite a bit. So I think the other part of it too, and whether this is for a finance student or somebody kind of that's more mature in their career, I kind of look at it more about kind of what the goals are for yourself. What are the goals you want to set for yourself, more than what just the job is that you're choosing, and kind of put yourself in a position where you always have options. So it really doesn't matter your age, or again, where you are in your career, but that you can, really kind of control your destiny to some degree and pivot in a way that you want to pivot if something comes your way. So I feel like, and that can be interchangeable whether you're in Wall Street or Main Street, frankly. And I think, while yes, we're all citing reasons for why we've moved from Wall Street to Main Street in a lot of different scenarios, I think it ultimately comes to, down to a personal level and kind of what your personal goals are and what you want to get out of life and what you want to get out of your career. So I kind of feel like it's less about what you actually choose, but more what you do with the path that you've chosen.
Guys, on that note, it's interesting. The flip side of everything we've been talking about today, for whichever one of you wants to take this, now that you've gotten a look at the other side, would starting off on Main Street have made you better or enhanced, your Wall Street career in any way? Or is what you've seen so far in your current roles about what you would have expected and you don't think it would have made it? Like, would other people benefit from kind of in their Wall Street role from seeing what you guys have seen so far to date in this role?
It's an interesting question. It's one that's hard to answer because you're contemplating where you would have entered, right? A long time ago. I'll answer it this way. You know, after 20 years of doing investment banking, I think, you know, after 18 months in this seat, you know, with a lot more to come, I'd be a better investment banker today if I had greater appreciation for how these companies actually work, perform, get plugged together internally, you know, the operational detail, and you know, all these cycles we talk about, you know, what you gain and learn from that, I think just gives you immensely greater perspective on the business, and not just the business, then how the managers of that business think about strategy, right? And so, you know, I do think there's real value in that.
Interesting.
I would agree with that. I definitely think that being a CFO now, if I went back, I could be a better analyst. And I do think that the eclectic nature of being an analyst did set me up to be able to be successful in the seat I'm in as well. So it's hard to know which comes first, but there's definitely benefits you would have from going from one direction to the other, or vice versa.
Let me ask you guys to put on your old hats for a minute here. Jeff, maybe starting with you. What's your prediction with your investment banker hat on of when we're going to see a pickup in M&A industry wide? It would seem like, you know, a lot of people I'm talking to are suggesting conversations picking up, maybe sometime in the second quarter, we start to see some announcements. What are your thoughts on what the remaining impediments are from here, and when we'll see companies get more active again on the M&A front?
Yeah. Well, it's coming, and the seeds of that are already being planted. You know, I definitely, you know, I believe strongly you're going to see a rebound take shape in 2021 in terms of M&A activity, and then that will really gain steam into 2022. You know, what do you need to get M&A going? I mean, you need confident buyers, right? That's a prerequisite to having an environment that's conducive to M&A, and we're seeing that confidence reemerge. You know, confidence that the virus is going to get wrestled under control, you know, in the near term, that credit issues are going to be manageable. That's a lot different place than we were at, you know, 4 to 6 months ago. Confidence in the level and direction then accordingly of performance, and relatedly stock prices, and confidence that they have the capital in place or ready access to it if they want to or need to pull the M&A lever. So, you know, I think we've made significant progress on those fronts over the last few months, and we just need to see it continue, and to avoid another material setback in the economy. And then you've got the seeds planted for that resurgence in M&A. Meanwhile, in the background, the pressures that have persisted for consolidation have just become more acute, right? Margin compression coupled with anemic organic loan growth pressuring revenue, the need to invest in technology to remain relevant and competitive. All of that begs for efficiency gains from scale and cost takeouts from acquisitions to help offset the pressure of both of those things. And I think the last thing is and we've seen it and we saw it coming out of, you know, as we recovered from the great financial crisis, as valuations have started to recover in the sector, in general, you've seen that recovery correlated to size and scale again. So you're seeing the valuation ladder reemerge that supports the quote unquote pay to trade dynamic really needed to foster an environment of stronger M&A activity.
Almost like, yeah, the deal math is such now with the larger, more liquid companies running, you know, up more so than the small guys, that it could be win-win all around. Guys, we ended our last webinar with Larry Mazza from MBB, Chuck Schaefer from Seacoast, and Eric Sprink from Coastal, all naming a company that they greatly respect, that they believe was doing some really neat things. Larry said Live Oak. Chuck talked about the national banks and the progress they've made and how they turned the ship around from when we all started as analysts 20 years ago, when they were the gift that keeps on to the small banks. But the award, I think, goes to Eric Sprink, who named Silvergate, and that stock's up, you know, about 500 to 1,000%, I think, since he was on the webinar last month. So no pressure, but Can each of you take 30 seconds and give the audience, and I'll extend it to not just a company, but maybe a person, a person or a company that you guys think each are doing something particularly neat and noteworthy right now. Maybe Jefferson, Jeff, and then Collyn.
All right, I'm going first here. All right, so this is a little bit slightly different than the question you asked, but I'm going to get there. So the most recent stock I bought is Live Nation that manages the concerts and such. It's sort of a play on returning from a pandemic. I mean, this goes back to my time from as an analyst. I mean, one of the things that I've learned as a CFO is that culture it makes a big difference. And as an analyst, I care more about margin and efficiency ratios than culture. But I'm going to go to a bank I used to cover called Pinnacle. They have an outstanding culture, and I think it's been what has made that bank work so well since it started in 2000. And that's something I've come to appreciate about United Community too, is our culture. I think we're trying to do anyway the same thing. So I'm going to put Pinnacle Financial Partners out as my name to think about because of their culture.
And I'll give you a company and a person in mind. For me, Triumph Bancorp, ticker TBK, down in Dallas comes to mind. They were a close client of mine for a number of years. They've successfully paired technology with a focused mission to deliver innovative customer-focused solutions addressing, financing, payment, and cash management needs in an industry that's ripe for share consolidation. And in so doing, they've carved out a highly profitable and scalable niche. Certainly, culture is a big part of that place as well. And that starts with the leadership, and Aaron Graff there, the CEO, I just give him a ton of credit for not being only really smart, but also passionate, committed to his vision, and making that vision and passion really, contagious. As I mentioned, they were a close client of mine for many years, and I saw firsthand how he and his team remained steadfast in their mission through what was at times, skepticism from peers, from analysts, from investors, and that focus and relentless commitment to their strategy is yielding some pretty impressive results now.
Great, Collyn.
So these aren't really stock calls per se, because you can't help but wonder if maybe the stock market's a little bit broken right now, and I'm relieved not to be a bank stock analyst at this point. But I'm, still, that said, I'm still an old school bank analyst at heart. And I think so from a company perspective, a company now that I have not followed in my career, but just kind of observing of late, would be First Republic. And I say that because I think I have just a great appreciation for a company that really knows who they are, and they know what they're doing and know what they're good at. And I think First Republic's done a great job in that regard. And similar to what Jefferson said and what Jeff followed up on, is this is not a bank industry person, but I recently finished or read the book No Rules Rules by the CEO of Netflix, Reed Hastings. And it was a fascinating read in that, what he's done with that company and turned it around massively and just completely redesigned the business model. Not that that's the intention of what I'm going to do here at Valley as the director of strategy, but nonetheless, I mean, it speaks to what you both, have been able to appreciate and be a part of now being at your respective banks. And I'm just learning culture, but that's somebody who, the business, to turn a business model around like that is pretty impressive as far as I'm concerned. Those would be my two.
No, I think it's really interesting. So all three of you guys named companies that trade at significant premium multiples already.
Because we don't have to pick stocks. I just told you that.
Not picking stocks.
I agree with you, right? Not the value, going to the discount bin to pick something that really hasn't rallied yet. I think it's interesting. Kind of speaks that you all three mentioned some names that have thrived in this environment, and with valuation not seemingly impediment to them continuing to do well. certainly agree with you guys. But with that, guys, we are about out of time. This was a lot of fun. So I'd like to thank each of you guys, Jeff, Collyn, and Jefferson. Good to see you guys again for taking the time to be with us today. So Brian, I'll turn it back over to you. Any closing remarks?
Yeah, no, thanks again so much, for joining us, Jefferson and Jeff and Collyn. In closing, we heard about each of your career trajectories, which I think our audience will find quite refreshing as they look at their own careers. We spoke of the importance of relationships that are made throughout your career and how they help guide your career. And we got some terrific insight, not only about the industry, but about how your respective organizations are employing your unique talents to empower their growth. So I just want to say it's been a pleasure having you all. Thanks for your participation, and best to all of you in your future endeavors.
Thank you. It's great to be with you.
Thanks, Brian and Joe. Appreciate it.
And thanks to all the viewers that are watching as well. We appreciate it. Have a great night.